The MBA Research and Curriculum Center and NOCTI have collaborated on this microcredential. This microcredential explains financial modeling and is divided into 4 targeted skills. This targeted skill explains developing and using income statements. On an income statement, it is possible to see key items like earnings and profit. Earnings include a company's income. Profit is calculated once all expenses are paid. Many other types of reports or statements are derived from income statements. These must be accurate as they are used to determine a company's bottom line. Some call the income statement an operating statement, since it is used for making decisions about the operations of a business. For example, an operating statement will guide the owners when deciding to invest in new equipment or hire new personnel. Cash flow statements are derived from the operating statement. Cash flow statements have more detail and can give direction on how a business will operate. Income statements also can show earnings per share, which indicate to prospective investors whether the company is a good investment. This is calculated by dividing the company's net income by the number of outstanding shares of common stock. To develop an income statement, the first step is to gather the financial data in all 5 categories of input: revenue, cost of goods sold, cost of sales, gross profit, operating expenses, and net income or profit. Each category is compiled and totaled to determine the gross and net profit. The gross profit is an indicator of the company's efficiency in production, which can be compared to other years. Net profit shows how much money is being made or lost, and if there is a loss, investigating the data will find the source of the loss. Categories on the statement can be compared. For example, if operating expenses increased 15% and revenue remained the same, then business owners either need to control operating expenses or increase revenue to be profitable. Important ratios can be calculated from the income statement. Ratios show relationships and how one category affects another. Ratios result when dividing totals of different categories on the income statement. For example, when dividing the gross profit by total revenue, the result is a gross profit margin ratio. This gross profit margin ratio shows how efficiently a business uses materials and labor in the production process. If the ratio is high, then the business makes a reasonable profit. If it is low, then a strategy to control expenses or operating costs is needed. Making comparisons to the competition reveals strengths and weaknesses. This helps determine where a business is positioned in the market with similar business entities. It is important to compare the categories and their relationships from one year to the next. This helps a business understand its finances and give direction for the future.